As the minutes tick by to the end of October and Rachel Reeves' first budget, she is under pressure to announce a substantial increase in capital gains tax, CGT, in this upcoming budget, with a coalition of millionaire business owners estimating that aligning capital gains tax with income taxes could raise up to £14 billion annually. This comes in the middle of growing calls from within Labour and influential figures like Mark Campbell, co-founder of Higgidy Pies, who argues that such tax reforms will not deter entrepreneurs. Campbell says entrepreneurs don't think about capital gains tax when they create businesses. Increased capital gains tax would not have stopped us investing. Well, that's nice to know. The Institute for Public Policy Research has echoed these calls, recommending capital gains tax rates be equalised with income tax brackets, and currently capital gains tax is levied at 10% or 18% for basic rate taxpayers and up to 20 to 28% for higher rate taxpayers. The IPPR proposal would increase these rates to 20%, 40% and 45% respectively, aligning CGT with income tax rates. According to the IPPR research fellow Pranesh Narayan, the recent fear-mongering from some that increasing capital gains tax will take the economy back to the Stone Ages is pure hyperbole. However, economic modelling from HMRC complicates the debate, indicating that raising capital gains tax by 10% might reduce overall revenue by £2 billion due to behavioural changes among the high net worth individuals. HMRC's findings suggest that capital gains tax revenue is sensitive to investor behaviour, a point underscored by Edward Trump and the former head of HMRC, who warned that abrupt rate hikes might dampen capital transactions rather than boost Treasury coffers. The strategy Reeves is reportedly considering involves focusing on capital gains tax related to the sale of shares, while sparing second homes, where a 24% rate is seen as optimal for revenue. Capital gains tax on property sales remains sensitive, with past adjustments demonstrating that too high a rate can deter transactions, ultimately lowering revenues. Former Chancellor Jeremy Hunt's cut from 28% to 24% on property-related capital gains tax has shown potential to boost revenues by approximately £700 million over 2 years due to increased market activity. As Labour weighs its options, therefore, Reeves's capital gains tax strategy will likely reflect a balancing act between maximising revenue and mitigating capital flight. Keir Starmer has hinted that drastic capital gains tax hikes, such as raising rates to 39%, are unlikely, a stance that indicates Labour is cautiously navigating the potential fallout among investors and within its own ranks. With a fiscal shortfall of £40 billion, capital gains tax reform is but one lever among many as Labour seeks to avoid austerity while placating various constituencies.